Welcome to a new chapter in our accounting journey. We are getting ready to push into Chapter 5. But before we do so, I just thought it would be a good time to review because we are going to turn a corner in Chapter 5 and begin to look at some of the nuances of accounting when it comes to merchandising. Merchandising concerns. There are three major kinds of concerns or operations. The first is a service company, which is what we've been looking at so far. The first part of this book is looking at introducing concepts in accounting, but applying them to companies that are providing a service. Another kind of company, which is different than a service, is a merchandising company. Which is what we're going to look at now. This is where we are now. Chapter 5. Another kind of company is a manufacturer. And this we will not look at until a later date. In fact, we'll offer a whole class on manufacturing accounting. This is the most difficult accounting is when you're dealing with manufacturing. A service company is a company that provides a service. When you go to the doctor, that's a service company. You go to the dentist, it's a service company. Legal firms, service companies. Companies that will come and clean your house. A service company versus a merchandising company. What's a merchandising company? A merchandising company is a company that buys something at one price and sells it at a higher price. And we're going to look at the nuances of merchandising companies. But MC Sports is a merchandising company. The Gap is a merchandising company. They buy and sell merchandise. They don't provide a service. They sell goods. Manufacturing company is a company that makes something. They actually manufacture a product and sell it. So a manufacturer can sell to a merchandising company that then sells it to the public. But a manufacturer is a person that actually makes the goods. And in each one of these situations, merchandising and manufacturing, we have unique accounting issues. There are issues in accounting that have to be addressed when we talk about merchandising companies or manufacturing companies. So this is what we're going to be looking at in Chapter 5. But before we do that, I just thought a little review because we have covered a lot of material. Whether you realize it or not, just in 4 chapters in accounting, we've talked about a lot. We've talked about accounting. What is accounting? Accounting is an information system, right? What is it? What is this thing called accounting? It's the information system for identifying, recording, and reporting relevant business transactions. That's what accounting is. We learned about the accounting equation, assets equals liabilities plus owner's equity. I'm not going to be reviewing everything, but I just want you to see how far you've come because you have learned a lot of information, whether you realize it or not. You know what the accounting equation is, assets equals liabilities and owner's equity. We know that that's never violated. We also know that the P&L, the profit and loss statement, the revenue and expense, revenue less expenses equals net income, that impacts the accounting equation through owner's equity. We've learned what assets are. We've learned what liabilities are. We've learned what owner's equity accounts are. Assets are resources that a company owns or controls. Liabilities are claim. All of the assets are either obtained through liabilities, which means we now owe somebody for them, or we actually own them ourselves. So the liabilities and the owner's equity show where those assets came from. So we have our balance sheet. We have an income statement. We've looked at the accounting cycle, which has been a lot of what we've looked at. The source documents, original source documents, which then get recorded in a journal. And from the journal, they get posted into a general ledger. I'm just going to put R, P, S, R. Original source documents get recorded, then they get posted to the journal. Then they get to the ledger, posted to the ledger. Then they get summarized in a trial balance. And then we see there's adjusting entries, and they eventually get reported into our financial statements, our P&L. statement of owner's equity, our balance sheet. And after we report all these things, we say, hey, we're coming to the end of an accounting cycle, and we need to make closing entries. And we know the closing entries, anything that's a temporary account. Temporary accounts get closed out. Those are our revenue expenses, get zeroed out. Expense accounts get zeroed out. Owner's withdrawal account. All that gets zeroed out so that we can start a brand new cycle with a brand new period. And I've just been showing that as kind of a timeline broken down in time period 1, time period 2, time period 3, time period 4, etc. And the use of a worksheet actually to do all this to help us in the preparation of the financial statements, the preparation of the worksheet. So this is certainly not an exhaustive teaching, but I just wanted to review and kind of step back, think about all we've learned, because as we move forward now and talk about a merchandising company, there are some nuances that we're going to introduce into this, but it's not going to change everything. It's just going to be some nuances, certain ways of recording certain transactions. Again, I'm just going to call them nuances for now, because in the next video, in the next few videos in this chapter, we're going to talk what are the distinctions between a merchandising company and a service company. What are the things that are different and how do we account for them? But they're not going to change what we're doing in terms of accounting. They're not going to change our balance sheet. They're not going to change the fact that we have an accounting cycle. They're not going to change the nuances of the cycle. They're not going to change the fact that we have closing entries, that we can use a worksheet. None of these things are going to change. So we're laying a foundation. We're going to build upon it. And because things are not always exactly the same, we say, what about a merchandising company? What's different about it? How does it impact the accounting cycle? So a brief video, step back, look at all the stuff we've learned, take a deep breath, and now let's move forward into a different type of environment called the merchandising company. See you in the next video.